In Barron's, they had a round table of the leading research analysts in the major banks out there. And I'm going to give you a short summary of what these guys think. They suggest to overweight three sectors: financials, healthcare, and energy. So they think that the two worst performing sectors in 2019 might be the best performing sectors in 2020. If they overweight financials, it means they think that these companies are undervalued, selling at PE multiples way below the market of 19 times. These are companies normally that pay higher dividends than the rest of the group, which means they think that interest rates in general will be still low. Therefore, people are still going to be chasing value and dividend-paying stocks. In 2020, they all were concurring about stock market valuations, which are becoming very challenging, to say the least, selling at 19 times earnings. Most of them were thinking that total average return in 2020 will be about 6%. The way they get to this number, they think that the S&P 500 will be up about 4%, add to it another 2% in average dividends for these companies on the S&P 500. They all discuss two wild cards: US-China trade, and the second big wild card, who wins the US presidential elections in 2020. Very difficult to quantify that risk and make decisions when it comes to geopolitical risks. Most of them did not think that the 10-year Treasury yield will exceed 2.2% in 2020. Most of them were thinking that GDP growth rate on average will be 1.9% next year, and that is down from the last quarter of 2.2%. Mind you, in 2018, GDP growth rate was 2.9%, and in 2017, GDP growth rate was 2.4%. Our president is aiming at 3% GDP growth rate. Nevertheless, 1.9% GDP growth rate for our economy, the largest economy in the world, $24 trillion in size, is not a bad number whatsoever for 2020. Most of the research analysts were talking about unemployment numbers still at 3.5%. They were all talking about very high levels of consumer confidence and very strong consumer in general, and consumption being up there. Capital spending still remains relatively low, or the majority of them were talking about the recovery in manufacturing. It has to do with our China trade deal, phase one agreement that we signed, and what they think about the world economy, which is in general getting a little bit better than in previous years. Federal reserves around the world are expected to expand their balance sheet to the tune of $100 billion in purchases of their own treasuries per month, which means our US Treasury balance sheet will go up to about $4 trillion in size, and this is huge. Our US government still is running deficits per year near $1 trillion. One challenging space in the market might be, in general, fixed income investments, and in particular, investment-grade bonds. Half of investment-grade bonds are now rated BBB, which means ratings in general are being marked down, and investors in general are not getting a decent return for the risk that they take, in particular in the high-yield market. Barron's also mentioned what they think are their top 10 names in 2020. I'm going to mention a few names that I thought are interesting, such as they believe that Anthem Blue Cross can do well in 2020. One of the reasons is that the company sells at very inexpensive multiples, still at 13 times earnings, 40 million individuals in their service platform. They think Anthem Blue Cross that they can increase these numbers north of 40 million customers that they have. They also plan on selling health insurance that cover dental and vision to their existing clients. They also might start looking at ways to make money with their analytical data that they collect on us and how to monetize that. Another company that was mentioned is Viacom, which sells at 6 times earnings and might be gearing up to start selling streaming because they have an unbelievable content. One of the companies they mentioned is Google. Last week, the two founders of Google, Brin and Page, decided to step down and hand over to the CEO of Google, Sundar Pichai, a total control of the company, which means now he's going to be in charge also over all of Google's moonshot businesses, such as Waymo, which is their autonomous driving unit, and Verily, which is their healthcare unit. At the moment, it seems like Google is quite expensive, selling at 25 times 2020 earnings, or $54 expected earnings per share in 2020. However, in my view, it might be that PE ratio of 25 times over and above the 19 times earnings of the S&P 500 is inflated. And why am I saying that? Because number one, if you adjust the PE ratio to the cash net of debt that Google has on their book, which is $117 billion and or $150 per share, and you also back out of the numbers what they lose on their moonshot businesses, which is about $4 a share. If you back these two numbers out of their earnings per share, then you end up with a company that sells at 20 times earnings. And yet Google is still growing their revenues at a rate of about 20% per year. Last year they grew their revenues at 23% per year. So this is still a very strong growth business. The issue there is that with all their moonshot businesses and high expenses, they are not getting the profit margin that other tech companies are getting, such as Facebook with 40% profit margin. Google's profit margin is about 24%. Everything I say it with a grain of salt, and this is not a recommendation to go and buy Google. But I thought it is important to mention these things. Google has an incredible set of businesses. They have their number one search business, they have their Chrome business, the Gmail business, Android, Waze, Maps, YouTube, which by itself brings in about $20 billion a year. Some analysts on Wall Street believe that Waymo alone is worth $50 billion in market valuation, which is about $100 to $200 a share if they were just to spin off that business. One of the issues that are still outstanding with Google are meager buybacks. In the last 4 quarters, they bought back only $15 billion worth of shares. If you compare that to Apple, for example, Apple purchased in the last 4 quarters about $67 billion in shares. Apple this year is up north of 75%. Google this year is up about 29%. The difference is Apple saw their revenues shrink about 2%, and Google, on the other hand, saw their revenues going up this past year about 20%. So the issue is get better transparency, try to improve your profit margins, increase maybe your buybacks, do a few good things that are positive for shareholders. And if that is the case, we can have a company that will do not too bad in 2020.
So as we're winding down 2019, we'll take one last look at the yield curve and how that's been behaving. The 2-year versus the 10-year temporarily inverted back in August. The short-term interest rates, the 1 month to the 3 months versus the 10-year, had been inverted for a while, but they are no longer inverted. As of October 2019, those are good to go. Currently, the average spread between the 2-year and the 10-year is positive by about 19 to 21 basis points. So from that inversion to a typical recession, the shortest inversion to recession time frame has been 7 months historically, and the longest has been 19 months, with the average inversion to recession sitting right at 14 months. So based on the shortest historical inversion to recession, that would take us until March of 2020, and based on the average would take us until September of 2020 before historically we would have a recession fear.
Hello everybody, and thank you for watching our videos. I'm Amit Stavinsky, the Managing Director of Tamar Securities and its affiliates, 911 Financial Services and Firefighters United. As always, if you like the content, become a subscriber to our YouTube channel. Also, if you would like to speak to us directly, please call us in our main offices in Woodland Hills at 818-914-7461. The highlight of the week is that now, when we are approaching the end of the year, it is a great opportunities for clients to reevaluate their risk parameters and where they are in their life cycles. It is a time for rebalancing and reallocating investment portfolios. I would like to wish all of our friends, family, and clients good health and happy holidays for you and your family members.